Hello everyone, and welcome now to the fourth instalment of Conversations on the Couch here at Empire. The scale of funds that we manage here at Empire and the collective reach of the investment committee that we have means that we have access to investment funds that often aren't available to other advisors, or if they are, they're available to us on preferential rates, and means that we have access to the portfolio managers, the chief investment officers, the people who are making decisions in these funds. So we have that opportunity to have these discussions with people like that in Empire. And today we've got the pleasure of having Stephen Arnold join us today for Conversations on the Couch. He's the Managing Director and Chief Investment Officer at Aoris. We have the Aoris International Fund within the Empire portfolios. They're a really popular fund, one that's added significant value to the Empire portfolios over the last couple of years. So we've got the opportunity to have a discussion with Stephen and hear straight from the person that's running this fund about what's happening in the Aoris fund and what opportunities we can take advantage of. So thanks for joining us today, Stephen.
Ray, thanks for having me on the couch.
You're very, very welcome. Tell me, what does Aoris believe about markets that lead to the opportunities for Aoris to outperform?
Well, Ray, our overarching belief set as investors is that we are business owners and we believe in quality. We believe in the wealth creation of leading, durable, resilient, high quality businesses. And I'm sure we can talk about a few of them, but in our portfolio, you'd see leading businesses like LVMH in luxury goods, L'Oreal in beauty products, Nike, Accenture, Microsoft. So we think that there's no better place that we can think of being in global equities than in being the best businesses. And that's what you'll find in the Aoris portfolio.
Yeah, it's one of the great things about the Aoris funds. That's it's maximum 15 stocks. Is that correct? Yep, 15 stocks is the maximum. So it's very high conviction. You need to believe in these businesses. And yeah, some of these are household names, as you mentioned, but some of them are not so well-known names, but have tremendous stories behind them and are great growing businesses. So yeah, I'm glad that we'll be able to touch on a couple of those later on in our discussion. So this belief that you have in investing in great businesses, how do you take advantage of this belief, and how does that then lead to excess returns over time?
Well, I think the first thing is to be an awareness of where vulnerabilities are, what sort of industries don't lend themselves to the growth, to the profitability and the durability. And first of all, avoid those. So you'll never see banks in the Aoris portfolio, which has been helped us to avoid some of the troubles that you've been bubbling to the surface in European and US banks in recent weeks and months. We won't own energy and mining businesses that are susceptible to changing commodity prices, just inherently no growth businesses like utilities and telcos, businesses that are just inherently very competitive and hard to differentiate yourself, businesses where the government plays a big role, emerging markets where the governance and transparency can be a headwind for us. So taking all that off leaves us a much more productive but smaller opportunity set. And as you said, owning 15 of them allows us to set our criteria very high. We're looking for the great, not the good. We're looking for truly exceptional businesses, and price matters. Being very concentrated allows us to be very selective about not only the business that we own, but the price we pay for them. And I think that combination of great wealth creating durable businesses that are understandable, that lead their markets, that grow profitably, that grow in value over time, and being very discerning on the price we pay will help us to achieve good returns for investors in the coming 5 or so years.
Yeah, 15 stocks out of the sea of companies that are all around the world. It's a tough choice to choose 15 out of all of those opportunities that are out there. So it's interesting, as you say, what you will exclude and what you weed out, and what you do actually focus on that will lead to those excess returns over time.
Yeah, okay, so maybe it's touching on the best businesses. We like businesses that lead their markets, particularly where being the leader really matters. And when we came in to see you this morning, we drove from the airport past the Opera Stadium, but also past a Costco store. And that's a good example of where being very large, not only in a local but in a global context, is very beneficial. They spend $250 billion a year buying product, which has meant that through the pandemic, during periods where it's hard to procure product to put on the shelf, they had much better access to the products that they wanted to put in their stores than the people that they were competing with. So product availability helped to keep their service levels high. They're a business that's always chosen culturally to pay their staff well above minimum wage, which has been very advantageous during periods of tight labour markets. It's a business that is once you pay a membership fee, that when you go through the door, that you want not only high quality products but good value, and they're able to deliver that. We noticed on the sign outside the door that diesel's $1.60, which I think is the best value if you're filling up your diesel car in Perth at the moment. So good quality prices, and that size and scale muscle has allowed the business not only to continue to serve their customers but take a lot of market share through the pandemic period.
Yeah, there's certainly, there's only two of them here in Perth. Obviously, Costco is an established brand in other parts of the world, but it's certainly one that's growing in popularity, and for all the reasons that you just mentioned, really solidifies it as a future growth brand. It's good that we've touched on a couple of these examples already, because what we'd like to know, and what our community would like to know, is where you see the markets over the next 1, 2, 3 years, and how that's reflected in the portfolio right now. So what choices are you making in the portfolio based on where you think the market's heading, and a couple of examples of some of the companies that you're owning at the moment.
Yeah, well, the principles that are expressed through the 15 businesses we own in the portfolio are always present, and we think that will help us to achieve good results through time. And some of those principles, in addition to the characteristics of consistently profitable, leading, growing businesses, are a strong balance sheet, a conservative capital structure. A couple of years ago, when interest rates were very low, it didn't feel like it mattered very much, but that's a characteristic that's always important to us. And I think we're going into an environment now where the value of a conservative capital structure is more evident, but for us it's always important. And so those principles don't change. As I said before, we won't own banks ever, but that's a characteristics of what we choose to own and what we choose to avoid, that right now is more pertinent, more front of people's minds. So we don't have particular views on the economy, we don't have particular views on equity markets, but we do have strong views on the businesses we own. We would believe we've got a set of businesses that are competitively winning, that are durable, that have been around a long time, that are run by conservative and judicious management with strong corporate cultures, businesses that keep their customers a very long time. We know that Costco's membership renewal rate is about 92%. Okay, well, that's a good sign that people like coming back to the store and willing to pay their membership fee every year. Businesses that are broad, we avoid narrow businesses that are fragile because they might have one product business or serve one set of customers in one country. Costco is another good example. The breadth across lots of products sold to lots of households and lots of places creates durability and balance to the business. So those characteristics we think will serve us well as investors. Those 15 businesses are resilient, conservatively financed, strong cultures, competitively winning. And whether the economy grows a bit more or a bit less this year, if inflation's a bit higher or a bit lower, interest rates are a bit higher or a bit lower, won't change how Costco continues to grow over the next 5 years profitably. It won't knock L'Oreal off course, L'Oreal being a business in our portfolio. It's strong capital structure, strong competitive position. It's not a business that's going to get blown off course by the course that the economy takes this year. So we feel very confident about the nature of the businesses we own and their ability to do a good job for investors over the next 5 to 7 years.
So Louis Vuitton, Moët Hennessy's in the portfolio, so that's a luxury company. So given interest rate rises, potential recessionary pressure on the horizon. What do you think that's going to mean for a luxury good manufacturer with so many luxury brands in its stable?
Well, you're right. It has lots of brands, including the Louis Vuitton brand and the Dior brands that can naturally come to mind. It serves customers in lots of countries. It serves customers when they're traveling, when they're at home. So there's a lot of balance in what it does. Right now, their Chinese customers are starting to travel again. They're going back to the stores. And so it's a big part of the business that's really coming from being really below normal, below potential, and back and growing very strongly as we sort of go through April and May. There are other parts of the business that are continuing to grow from an already post-pandemic recovery period. But that's not true of all their competitors. There are some of the brands that they compete with are not doing so well. So it's not a case that luxury uniformly is doing well and everyone's doing equally well. I think LVMH has taken, much like Costco, taken a lot of market share through the last 3 years, stemming from its willingness to take a very long-term view, invest a lot in its brands in times where other competitors pull back. Its ownership of some of the best brands, the ones that are most desirable. That sometimes when consumers have got to make a choice, well, I'm going to direct my shopping to the strongest brands with the richest history, the strongest stories. Some people might have been reading that the flagship Tiffany store in New York, made famous by the Breakfast at Tiffany's movie, has just reopened. It's been closed for 3 years. The company spent reputedly in the order of $200 million refurbishing that store. And now it's just come back to life. That's a long-term decision that not many companies would make, but LVMH thinks not in quarters or years, but in decades. And that Tiffany brand is a much stronger, much healthier, much more vibrant, much more appealing, much more resonant brand than it was when they acquired the business around 3 years ago.
Wow. Look, great examples of how that philosophy sees its way into the portfolios and the companies that you choose. So, look, thank you very much for your time today, Stephen. It's always a pleasure. I say the Aoris Fund is always a really interesting talking point with our clients. So we hope that others in our community got something from this discussion today. If you do have any questions at any time, please feel free to contact the Empire office, and we will be always very happy to assist. Thank you.